13.37. So the valuation for PayPal is incredibly cheap, and this is trading for a steep discount, like a big value stock. Now, a combination of the stock just being down year to date and the cheap valuation makes me really think that makes PayPal so attractive. The profit margin is 14%, the operating margin is 20%, revenue was $31 billion, and revenue per share is $31 per share. Now, quarterly revenue growth was 1.2%, but quarterly earnings growth year over year was 45% essentially. Now, they do have a lot of cash on the balance sheet, but they also have a lot of debt, and that is one reason that this stock is trading for a pretty big discount. Now, in terms of macroeconomic concerns like global economic slowdown, it may hurt short-term growth, but because of less consumer spending and less travel. However, long-term economic recovery is highly probable, favoring PayPal's comeback. The company is sitting at a $63 billion valuation. Despite competition, PayPal still controls 45% of the global payments market and remains one of the top mind payment processors for most consumers worldwide. Now, I also like PayPal because they are looking to create more income, they're looking to diversify their business, and they're expanding into the crypto market. So they launched PayPal USD, which is a stablecoin showing innovation and relevance in the crypto space. Now, they also introduced 3.7% yield on PYUSD to incentivize usage rewards. And this is really interesting because it's kind of similar to Wise. So I use Wise to pay my contractors and employees, as well as PayPal. So I'm using both, and yeah, both are offering APY and yield, and that's also what SoFi does. So looks like the market is really fierce and competitive right now for, kind of like the banking style where users are giving cash, because these fintech companies, and PayPal is a fintech company, they can make a lot of money through, various products and just really loaning out the money. Now, PayPal doesn't loan like SoFi, but they have a lot of use for cash. Obviously, the more cash they have, the better. And the crypto strategy that they're using could really increase user engagement and boost transaction volume, which is what PayPal cares about, because the more transactions are done, the more fees that they collect. Now, what's crazy is this is a value stock. It has a really low valuation, low price to earnings, but they're still continuing to look at cost-saving methods. So they're looking at cost-cutting and further profitability. So PayPal has recently undergone aggressive cost-cutting, improving margins and efficiency. They reduced headcount, and operational expenses are helping to preserve cash flow. Now, they have really strong cash flow, actually. So if I go to the financials tab of Yahoo Finance, they have really strong financials. So for example, like total revenue is still growing year over year, like TTM is trailing 12 months. If I go to the cash flow right here, you'll notice that, they are bringing in really good operating cash flow. And if I scroll down here, their free cash flow is actually like massive. Like, this is very massive free cash flow. The reason why I think PayPal is undervalued at these levels and it's probably going to be like an $80 to $100 stock is because they still have some more monetization to go, specifically Venmo. So Venmo continues to be under monetized, and there's significant upside if PayPal finds better ways to generate more revenue through Venmo. I'm sure you guys have used Venmo before or heard of it. So now let's talk about international expansion. PayPal is expanding international footprint, especially in under-penetrated regions. So this is really important for, more revenues and less competition. Because look, it's hard to compete in the US. There's a lot of companies, but if you go international, that's amazing. Just less competition and lots of profits to still be made. And let's take a look at global e-commerce growth. I think that global e-commerce growth will help drive international usage. Last but not least, they are also using AI. They invested in AI-driven fraud prevention to secure platforms and reduce losses. All right, let's talk about Starbucks now, which is the second stock that you should be buying in May 2025. Starbucks is obviously a really big blue chip stock. Everyone is addicted to coffee, and this is a really great company overall. Amazing management. However, the company has pulled back a tremendous amount. You can see here in the 1 month chart, the stock is down 16.5%. Year to date, the stock is just down 10%. And this is a really good opportunity to buy a high quality company that has not really rebounded as much as the rest of the market has. The stock really rocketed higher in mid 2024 when the struggling coffee chain hired food service CEO Brian Nicole, but it has since given back most of that rally. And Nicole, who is the CEO, he has a back to Starbucks plan. And this is showing really strong early results with changes like a simplified menu, a renewed focus on trimming customer wait times, and improving the in-cafe experience resonating with consumers. In the most recent quarter, nearly all customer-related metrics improved sequentially. For example, comparable same-store sales declined 4% year over year, but this is a significant improvement from the 7% decline recorded in the prior quarter. So yeah, don't get me wrong, this company is not necessarily cheap by any standards. However, I will point out that the long-term future of Starbucks is very bright. The reason why I say it's not really cheap is because the PE ratio here is almost 30. So as I was showing you with PayPal, PayPal's like literally half of this. So Starbucks trades for double the PayPal valuation. Now, this is also kind of interesting why it trades double the valuation. This is also why in my Discord community, I always tell students that we need to compare apples to apples, not apples to oranges. We can't compare Starbucks to PayPal. But I will tell you the reason why the PE ratio is higher is because Starbucks is going to have safer cash flows into the future. There are companies that can significantly take market share from PayPal. But for Starbucks, yes, they have competition, certainly in China, but probably overnight or in the next year or even in the next decade, they're not going to have a significant risk to their business. Now, what I want to point out and why I'm bullish on the stock right now when the stock is selling off and a lot of people are not bullish and a lot of people are pointing out there's still more room for a downside. Well, the reason why I think it's an interesting opportunity now is because a lot of analysts already came in with lower expectations. Like you can see on the screen, like this one lowered 83 to 79, 109. This one from 102 to 90. This one from 95 to 83. This one went from 105 to 90. Like everyone on Wall Street has already lowered the price tag for Starbucks, and that has already negatively reflected in the price. So a lot of the bearishness is priced in. And now for the bullishness long term, I'm just looking at what they're doing, and the operational changes that they're making are very amazing. Like for example, the menu simplification. The menu has been reduced by 30% to streamline operations and reduce wait times. That's very important. They also have store enhancements. Stores are being redesigned to include more power outlets, expanded seating, and distinct areas for dining in and to-go orders. Now, last but not least, customer experience. It is all about the customer. I think the whole reason that Starbucks took off was they had a really unique customer experience. They were writing your name on the coffee cups, and they were being very just good personalities, right? And people like that. Positive energy is really good. So their customer experience has improved with initiatives like introducing ceramic mugs, handwritten messages, which they've been doing, but I guess they're going to have more training on actually writing your name properly, and self-serve condiment bars aim to enhance the in-cafe experience. While short-term challenges persist, the strategic focus on enhancing the customer experience and returning to core brand values positions Starbucks for potential long-term growth. And I think over the long term, this stock is going to be a $100 stock. Now, that doesn't mean that you're going to get rich overnight, right? I mean, $100 from 82 is basically, around 20% return. But for me, 20% is pretty good. Like that is a really good return on a safe investment. All right, let's go on to the next stock, which is going to be SoFi. The stock is trading down. So if you look at year to date, the stock is down 18.77%. And they just recently had earnings, which were very, very good, but the stock didn't really rise a whole lot. But also, I will point out that it has stayed very stable, which has been amazing for option selling. So you guys that are watching my YouTube videos, you might be saying, well, SoFi's standing still, and I'm a subscriber, but I'm not making a lot of money. Well, in my Discord, we are making a lot of money because we're selling options, and when the stock stays the same, we're making hand over fist money, bicep over tricep money. So just pointing that out. So although SoFi didn't have excellent momentum after the earnings, that doesn't really mean that this stock is not a really good stock to own long term. In fact, I am pretty much more bullish than ever on SoFi. As SoFi grows, there's tremendous opportunity to strengthen customer relationships and build its ecosystem, especially if rates fall and loan demand surges. Right now, the average SoFi customer has fewer than 1.5 products, and a product is something like a loan, a bank account, or a credit card, or something like that, right? And they have the famous upsell model. So what they're looking to do, they're looking to cross-sell you. Once you get in, they're going to cross-sell you on more products. They're going to cross-sell you on some banking accounts. They're going to cross-sell you on some credit cards, some loans. They're trying to cross-sell. They're trying to make money on the back end. And I think this is fine. Like, you get customer in the door and then you try to get more of their wallet. Like, why not? That makes a lot of sense for a business. So the Q1 highlights in their financial results was $771 million, up 20% year over year on their GAAP net revenue. Their adjusted net revenue was $770 million, a 33% increase from Q1 2024. And net income was $71 million. That is some good income. Now, the income is probably only going to go up because SoFi recently became profitable. So they're likely to continue to make more money. And that's a good thing. If you also look at member growth, they added 800,000 new members, bringing in a total membership. It's almost 11 million people. This is pretty wild. As they continue to grow and dominate, I don't think they're really looking for profitability like today. They're looking to add more customers because more customers means more upsells. More upsells means more money. And looking at their product growth, they introduced 1.2 million new products, totaling 15.9 million products, up 35% from the prior year, which is wow. Like, what can you say? 35% growth for a mature company, a fairly mature company. That is unreal. And loan originations are also really good. They achieved a record 7.2 billion in total loan originations, including 5.5 billion in personal loans, up 69% year over year, and 1.2 billion in student loans, up basically like 59%, and 518 million in home loans. This company is doing very well, $13 billion valuation. I actually think this valuation can probably get to like 20 billion or above within the next 6 to 12 months. I think it's interesting now to get into the company in May because look, you got to get early. You got to be early on the horse, and the earlier that you are, the better. Because look, next earnings is probably going to be even better, and this earnings not too much happened, which means there's probably a lot of pent up demand. And I'm also guessing that a lot of investors have been very happy with the performance. A lot of people have gotten rich with SoFi, so yeah, they've sold off and taken some gains. But yeah, next 3 months is going to be very interesting for the stock to say the least. Now, for stock, this is a Chinese company, NIO, and they have fallen down a little bit. So I think it's a really smart opportunity right now. Like year to date, the stock is down 10%, so pretty in line with some other stocks. But it's a very cheap company, like for the innovation that they have. And they have lots of technology, like battery as a service. And the market cap is actually the smallest market cap of all the companies that I'm covering today. I think there's a lot of issues in China, but at the same time, if you have like 1% or 2% of your capital that you can put into a high growth company, I think NIO is a very interesting choice. And they are expected to report earnings, their Q1 earnings, on Thursday, June 5th, 2025, before the market opens up. And this date is based on historical reporting patterns, so it could change, but we have about a month until they come out with earnings. And for the first quarter of 2025, NIO delivered 42,000 vehicles, marking a 40% year-over-year increase. Now, we know that China is unstable, but we also know that China likes to help their homegrown companies. Like, why wouldn't they? So a company like NIO has been around for some time, and I'm looking at investing in NIO, small quantities, starting to dollar cost average into it to really have that upside in the stock, because NIO delivered 21,000 vehicles in September 2024, marking a 35% year-over-year increase from 20,000 vehicles from its premium brand and 832 from its Envo sub brand. And for the third quarter, just going back a little bit in 2024, they had over 61,000 deliveries. So this company is delivering a lot of vehicles, and NIO's cumulative deliveries reached basically over 600,000 by the end of last year. So the company reported really strong earnings, and their market share continues to just increase. weeks. So the company's scheduled to report earnings soon, and I think the next earnings is going to prove, just some big numbers. And also, NIO introduces third brand Firefly, targeting the compact EV market, with the first model set to deliver in the first half of 2025. So we have a lot of things coming up for the company. The Firefly brand aims to compete with models like, BMW's Mini and Mercedes Smart, offering advanced smart EV technologies. So yeah, they're probably going to be effectively competing. But yeah, that's enough about NIO. Let's talk about Walmart as my third pick in my portfolio. I have a lot of Walmart actually, and what I liked about Walmart, there's a lot of things that I like, but you can see here I have $1 million of Walmart. Makes up over 30% of my portfolio. One of the largest retail chains ever, really, has proven a dependable choice for long-term investors. So this stock has done very well during the volatility in the market. If I go back here and I show you the chart, Walmart has been really just reliant and resilient in volatility. And this was a big component of my portfolio, which has definitely saved me a lot of money. And over the past 1 month, it's up 10%. And then year to date, it's also up.
Did you invest in
predictable.
Walmart?
This is what I talk about, with my clients that are trying to retire or already in retirement. They're asking me, how do I produce stable, consistent income? And I'm like, hey, look, it's Walmart. I have covered calls on Walmart right now, and I have a lot of stock on Walmart. And look, I think strong performance and comparable same-store sales is very important to keep in mind. The Walmart same-store sales, which reflect year-over-year performance, locations open for at least a year, including online sales, have steadily improved over the past 10 years. Companies continuing to just improve. This growth stems from the strategic store innovations. They introduce more private label products and better prices with Amazon, and they're also expanding digital e-commerce capabilities. So that is pretty wild. They also have Sam's Club, it's a warehouse chain, also performed well, staying competitive with Costco. So look, Walmart's not playing around. They're like, hey, Amazon, move over. We're getting some piece of the pie as well. We want some cherry pie. We're hungry too. And then when it comes to Costco, we're like, hey, Costco, we realize that you have a fantastic business, and hey, you guys gotta have like a monopoly here. We're gonna come in and get some piece of the pie as well with Sam's Club. So they have steady physical store growth, while Walmart global stores count actually dipped from 11,500 to 10,500 over a couple year time frame during COVID times. By fiscal 2025, it operated 10,700. So they're back with the growth of stores, and they have very resilient costs. Walmart benefits from scale, which allows it to operate with higher growth and operating margins for many years. It's called economies of scale. Not economics 101. The bigger a factory you have, the more you can produce for a lower price, which is exactly how China literally, became such a huge economy with a lot of their manufacturing. Now, Walmart is specifically very resilient to tariffs. They just really don't care, despite relying heavily on products from China and other parts of Asia. Walmart is well equipped to manage potential tariff challenges from Donald Trump's policies and all that. And I think that, they really don't care about tariffs. Even if they do raise prices and stuff, it will likely still remain very affordable, and they're going to navigate because, Walmart kind of operates, they have a lot of cheap stuff. So if prices increase for them, prices increase for everyone. So they don't really care. They're just they're going to eat it with everyone else, but they're going to do better than everyone else. The company continues to repurchase stock as well. So they repurchase 6% of their shares. I just think it's a really good growth story, really good value story. The PE ratio is not super cheap. If I look at the PE ratio here, it's a bit higher, but also it's because the company's actually growing and expanding profit margins. So yeah, I think this is like a no-brainer play. It's my fifth choice. If you want to see more of my choices in my stock list of everything that I'm trading and actually watch me trade live, then I encourage you to check out the first link in the description. And thanks so much for watching, and I'll see you in the next one.